Over the past 2.5 years, investors have enjoyed great returns and consistent monthly dividend payments from JP Morgan Chase's Equity Premium Income ETF, known as JEPI. JEPI, true to its objectives, has delivered less volatility than the overall market while conducting out-of-the-money S&P 500 index call options, which help fund the monthly dividend income. This is why investors have been licking their lips this past summer when JP Morgan came out with a new fund called the NASDAQ Equity Premium Income ETF, also known as JEPQ, ticker symbol JEPQ. The fund objective is to give monthly dividend income while keeping open the door of capital appreciation. This really is a best of both worlds scenario. JEPQ aims to provide this to investors by selling options and investing in large cap US growth stocks. So many of these companies, they may pay out dividends, and the growth stocks that JEPQ is holding, they have the potential for covered calls to be written against them. Just like JEPI, JEPQ also aims to have lower volatility, which would be great in today's market, because I know I'm not the only one tired of seeing these non-stop red days. The fund also claims to have top-notch proprietary data, science-driven investment approach, which allows them to create a well-designed portfolio with risk-adjusted returns. Now, I take that with a grain of salt since every fund claims this, right? They all claim and promise that they can deliver stellar results, but at the end of the day, actions speak louder than words, so if the fund's performance is great, that's the only data science I need to look at. JEPQ is also managed by the same fund manager who oversees JEPI, Mr. Hamilton. Always gotta trust the Hamiltons with your money, and this time he's brought his frat buddies Eric and Andrew, who collectively have nearly 60 years of industry experience. JEPQ has a 35 basis expense ratio, which is exactly the same as JEPI. For all the work that goes into maintaining this fund and all the money it would take to do this manually by ourselves, I'd say that's worth it. It's also lower than many of the Global X products. Let's take a look at the holdings of JEPQ, which is only 84 positions, compared to JEPI, on the other hand, has 122. And while companies like United Health Group, Hershey's, and Progressive make up the largest positions of JEPI, the largest ones in JEPQ are Apple, Microsoft, and Google. Those three alone make up nearly 25% of the portfolio. In addition to Amazon, they also hold a bunch of equity-linked notes, just like JEPI. And JP Morgan has always been pretty hush-hush about what these actually consist of. Because the fund is trying to replicate the returns of the NASDAQ 100, it's going to have very heavy exposure to tech. Keep that in mind if you already have lots of tech companies. This won't be a great diversification tool. With 40% of its portfolio toward tech, about 13% each in communication services and consumer discretionary, again matching the NASDAQ 100 index, the companies will be US based and make most of their revenues in the US, though that isn't to say that they don't conduct business internationally. Alright investors, I know you're here to learn about the company's dividends and the chances of those dividends continuing to be juicy. JEPI has done a fantastic job of paying consistent monthly dividends. Their 12-month dividend yield is 11.26%, despite how poorly the stock market has done in the past year. JEPQ, on the other hand, only has a 12-month yield of 4.91%. That would be impressive outright to just get a 5% return with JEPQ, but JEPQ actually has much more dividend potential. This is of course because JEPQ only started paying out dividends in June. But no worries, we can use the 5 months they've been paying out dividends to get a monthly average of 41 cents a month. Now that gives us a 12-month total of $4.92, and if we divide that by JEPQ's current share price of $41.75, we get an amazing yield of 11.78%. People always want to know, how many shares do I need to own to get $1,000 a month in passive income? Well, it would take 2,439 shares of JEPQ to reach that $1,000 milestone. According to their prospectus, distributions will be taxed as ordinary income, which do not get preferential tax treatment unless they're in an IRA or other tax-advantaged account. I would speculate that some of their distribution will be taxed as qualified dividends, since they are holding on to stocks like Microsoft that pay dividends, since some of JEPI's dividends are qualified. JEPQ is able to fund this giant dividend by its equity-linked notes, or ELNs. Refer to my The Truth About JEPI video, where I go much more into detail on what ELNs actually are, as it's not a very easy topic to explain. The fund also makes money by selling call options on the NASDAQ 100. Premium will always go up when there's volatility, but it can go down in bear markets and sideways markets. And while the market is down today, that doesn't mean it always will be. In times of a bull market, JEPQ will likely underperform the market since its growth is being stunted with call options. JEPQ does 1 month out of the money call options designed to generate income for investors and have lower volatility. Let's take a look at a portfolio backtest to see how JEPQ has performed since its inception. Since May, a $10,000 investment would decrease to $8,700 for both SPY, which is the S&P 500 ETF, and JEPQ, while JEPI would perform the best at $9,200. JEPQ actually beats out SPY by about $50. So again, this is a super small sample size, but since May, the market has been down pretty big, so this further supports that JEPI, JEPQ, they can be a little less volatile than the market overall and offer a juicy dividend, which they have proven they can continue to offer. However, if this had been a bull market, I'd expect SPY to outpace both of them. That's why this fund is probably better for older investors who are in the wealth preservation mode of their investing career, rather than the wealth accumulation phase. That's not to say that younger investors can't hold smaller position in these funds and enjoy the cash flow that it brings as well. JEPQ should also experience some level of capital appreciation. Overall, I'm generally impressed with this fund. It seems like it could be a worthwhile replacement for QYLD. JP Morgan and Charles Schwab, these products never seem to fail to impress. Getting a chance at monthly dividends, capital appreciation, and lower volatility than the S&P 500 seems like a worthwhile investment. As I continue to build up my shares of JEPI, I may seriously consider adding some of JEPQ as well. I'd love to hear what your thoughts on JEPQ are in the comments below. Remember, this video was created by a subscriber request, so make sure you leave a comment on what video you want to see next. My videos are always found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.